Quick note before we get started in the video. If you are interested in purchasing the SPX Daily Key Levels V 3.0 indicator, you can email us at daytradinggps@gmail.com to request a discount promo code to purchase lifetime access to the indicator. To purchase the indicator, go to daytradinggps.com. Hello, in today's video we'll be taking a look at the Friday, May 1st, 2026 training session for the SPX CBOE index. We'll be utilizing three different trading indicators from Day Trading GPS. First off, the SPX Daily Key Levels V 3.0 indicator, the VWAP for SPX CBOE, and also the ribbon indicator for US indexes. Okay, so in today's session, we have several different trades that we're going to look at. We're also going to have a section on our early session lotto option strategy, which we just recently added in the last few weeks. Typically, we've had a lotto option strategy for end of day. However, now we have also added, in addition to that, a lotto option strategy for the early part of the session. So in today's session, we have our standard option play, which went from 1780 to 3730 for a $1,950 profit per option. And then in our lotto options for the early session, we have a lotto option that went from $2.70 to $10.90 for a 303% gain. Okay, so before we get into the trades, we're going to go through just a brief outline of the different indicators that are being used. One of which we want to point out to begin with is the VWAP for SPX CBOE index. Now, if you've been using TradingView for some time, you may already be familiar with this situation on TradingView. But on TradingView, if you're trying to trade from the SPX CBOE symbol, so that is this symbol here, which is the official CBOE index for SPX. This symbol, the data feed from CBOE, which covers SPX CBOE, the regular index, as well as if you go to XSP, that is the mini SPX index, which trades at 1/10 the value of the regular SPX CBOE index. That is also from CBOE. Both of those symbols do not provide volume data to TradingView in that data stream. So as a consequence of that, if you're trying to use the native VWAP indicators on TradingView, which we'll go ahead and show you now. So if you go to technicals that are built into TradingView and you go down to volume weighted average price, which is the standard VWAP, and you add that here, and then you can also try the VWAP auto anchored. So in each case here, you'll see a red exclamation point when trying to use the native VWAPs built into TradingView, and that is because you're getting a no volume data. So the data stream from CBOE does not provide volume data for any of the CBOE indices for SPX, either the SPX regular or the XSP mini. Same thing with the auto anchored, you'll get the red exclamation point, no volume data. Sometimes you'll just see that there's no VWAP, and sometimes you'll see that there is no red exclamation point, but nevertheless there will be no VWAP on the chart. So what our day trading GPS VWAP for SPX CBOE does is that it uses an external data source outside of that to provide the volume data for SPX CBOE or XSP CBOE, so that you can actually have a VWAP while on this chart. So this resolves the problem of trying to use two different charts at one time, one perhaps on a Forex CFD version of SPX. The problem with that is you're not really getting true volume data of the actual SPX on that. You're actually getting the volume data from the Forex CFD, which is useful to some extent, but it's not the true volume data showing institutional volume as well in the regular SPX S&P 500 marketplace. So our day trading GPS VWAP for SPX CBOE solves that problem, and thus we have, if I'll just go ahead and show you here, if I hide our SPX CBOE VWAP, you'll see now there's no VWAP on the chart because now we're just doing these two that were the native ones built in, so there's no VWAP. However, we turn it back on and now we have the VWAP with the bands. The VWAP here is shown in bright blue. That is because we are also using our ribbon indicator. The ribbon indicator also includes two thick yellow moving averages within the total ribbon. So we've made the native color, you can of course change it if you want, for the actual VWAP bright blue, so it's more easily discernible than the standard yellow. Okay, so we'll just go ahead and remove these now. Also, our ribbon indicator is different than most ribbon indicators because it does include a filter for US indexes. Yeah, it can be used on SPX, NDX, other US indexes. If you trade the Russell 2000 options, Dow Jones, as an example, it can also be used on that. Primarily designed for use on SPX and NDX, but you can also use it on other US indexes as well to enable the filter. So what this allows you to do is that if you would like, you can also have a dual screen with the ribbon indicator, in which on one screen you have the filter turned on for indexes and one you have the filter turned off. Right now this screen is showing with the filter turned on. We'll go ahead and turn the filter off, and as you can see here with the filter off, then the ribbon is also including this gap here, which you will see, which in some cases can aberrate the ribbon depending on the size of the gap. So you're not really getting a true sense in some cases on medium to large or extreme gaps. Whereas if you have a dual screen, which we'll show you in a second, where you have one with the filter on and one with the filter off, then you're getting more of a true sense from the open. In that case, if you're using a dual screen approach, you can have double confirmation from both ribbons if that is your preference, or you can just use one or the other depending on what your preference is, either to use double confirmation or just single confirmation with the filter on or filter off, or using double by using a dual screen. So for example here we have the dual screen on. On the left you'll have the ribbon with the filter on for US indexes, and on the right with the filter off. So this can give you an advantage if you prefer to have double confirmation, where the ribbon is giving you a confirmation signal on both with the filter on and the filter off. Or you have the flexibility to just use it with either or, if that is your preference, to just use it on a single screen. Okay, so in today's video, we're not going to go over in detail all the different aspects and features of the SPX Daily Key Levels V 3.0 indicator. We do have in the description of this video, there's a link to the setup and features video for the SPX Daily Key Levels V 3.0 indicator that is separated by chapters. If you go to that link and go to that video, you'll see in the description of that video it does have it is broken up into chapters, so you don't have to watch the entire video. You can simply go to specific chapters for specific features or inputs that you'd like to know about that particular indicator. We will go over briefly some of the features of the video before we get into the trades here for those of you who are not already familiar with this indicator from watching our other videos on SPX daily key levels indicator on this channel. So at the 9:30 a.m. open, the first tick at 9:30 a.m. Eastern New York time, you will get today's auto-updated key levels for today's session. So the most important level out of all the key levels is going to be the bull-bear key price level, which is abbreviated as KPL. We also refer to this level as the BBKPL. You also have the R levels, the main R levels above, and the main S levels below. So if you look here, you have the R1 through R6 and the S1 through S6. So these are known as the main key levels. The contextual key levels are going to be your pre-market high, which is PMH, pre-market low, PML, YDH, which is yesterday's daily high, that's yesterday's or the previous day's RTH session high, YDC, which is yesterday's daily close, the previous session's RTH session close, and then if we look further down, we'll see the YDL, which is yesterday's daily low, so that is the previous session's RTH session low. As you can see here, we don't really have, even though we have all 6 levels here, we don't focus on all 6 levels having them displayed on our chart because you can see here it kind of compresses this area here where it's a little bit harder to trade with all of these levels being shown. So if you normally have auto fetch data to screen, such as that, you're going to need to go over to the right hand part and left click on your mouse, and you simply expand the chart out by holding it. And generally what you want to do is you want to either show R3 down to S3 or R2 down to S2 or mid R2, R3 down to mid S2, S3, which we don't have turned on right now. But generally, most sessions, 80% of sessions are going to be contained with a 2-level extension above the BBKPL to a 2-level extension below the BBKPL, at least during the initial part of the sessions and about 80% of the sessions in a normal volatility environment. So you want to drill down so it's a lot easier to see these different levels. These levels here, these midpoint levels and QL levels serve different purposes. The QL levels above and below each main key level, the bull bear KPL, and the R levels and S levels serve as tight stop losses depending on whether it is a bullish or bearish trade from one of the main key levels. So you can simply go in the user control panel. The two that are turned on by default are the QL above the BBKPL and the QL below the BBKPL. However, you can change the defaults or simply turn them on manually when you wish, but they're available for each of the different main key levels, the R levels and the S levels, as well as the BBKPL. And that is because you can take bullish or bearish trades off of each of the main key levels, as well as the contextual key levels with this. With the contextual key levels, your stop loss and take profits on those are within the bullish and bearish trade section for the contextual levels, which is found here in the user control panel, and they're separated by bullish entries and bearish entries. You have a risk reward multiplier with a standard default of 2. It moves in 0.25 increments below 2 or above 2 up to a max of 30. And then you also have, you can choose between a standard stop loss and a tight stop loss if you like to trade the contextual levels as opposed to the main key levels. The stop losses and the take profits on the main key levels, the BBKPL, the R levels, and S levels are all determined by the key levels themselves, whereas with the contextual levels, you're using the control panel for both the stop losses and take profits on those. Okay, so right now then what we're going to do is we're going to also look at one other feature of this before we get into the trades, and that is the market scenario analysis. So if you see here, we have MS4 top overhang poke above. So this is market scenario 4, top overhang poke above. So at the first tick of the 9:30 a.m. Eastern Open, the indicator also does a market structure analysis for today's session. And what that means is that there are only 6 different market structures that SPX can trade in on any given day. The market structure is determined by 4 of the 5 contextual key levels: the PMH, the PML, the YDH, and the YDL level. And depending on the relationship of those levels determines the market structure for today's session. And the market structure factors into being able to also know what you're up against in any particular session as far as the dominant tendencies and trading characteristics of that particular market structure scenario. So that is also an important context to keep in mind in trading in general with this indicator. So for example, if we go into the user control panel, you simply go down to the bottom here and you will see show market scenario table. Now this is a fairly large table. It is set to a normal size. You can change the size to smaller or larger. And also you can change the table position. It is set to bottom left over here, but you can change it. Also, we have PDF one-page cheat sheets, which we'll briefly show you before we move on to the trades here. The PDF one-page cheat sheets have a little bit more information than the table, but all the core information is the same. The purpose of the PDF cheat sheets is that you can, after subscribing to the indicator, in the user guide and manual for the indicator, you'll get a link to the PDF cheat sheets also included in that, and you can go there and download them to your computer. You can print them out. You can study them in your off-screen time, or if you have multiple monitors, you can simply put up one of the PDF cheat sheet that's in question for the market structure scenario that's in play for today's session on a separate screen, or you could simply print them out and have them next to your keyboard for reference if you don't want to use the market scenario table on the chart. So we'll go ahead and turn that on right now. As I said, it is a fairly large table in the normal size, as you can see here. So what this provides is, symbol, what the analysis is for, what the date of the session, what the market scenario is, again, the levels, an explanation of what exactly this means, along with dominant tendencies and key trading characteristics of this particular market structure scenario, and also which key levels out of these 4 key levels that make up the market structure are the ones to look out for in this particular session. Now the PDF one-page cheat sheets that you will get with this indicator on a Google Drive link starts off with a summary page which does have an explanation of each market scenario, and then there is a one-page PDF cheat sheet for each of the different market scenarios, which again has all the same information. It's just as far as the core information, these have a little bit more information because we have a little bit more room here to present these, but the core information is the same. And it also gives it to you in kind of a color-coded, easier to read format as well. And here's today's market scenario 4. And then we also have market scenario 5. And then we have market scenario 6, which is the spans both sides wide pre-market. So this is the most volatile of all of the market scenarios. Okay, so now we'll turn this off and we'll get into the trades of today. Okay, so now we'll get into the trades of the day. To start off with, we have our 9:30 a.m. opening candle BBKPL alert. So this is an alert built into the indicator that is specifically for the opening candle. As you can see, we're on a 2-minute chart. The recommended chart time frames for the daily key level strategy, which we're showing you, are between 1 minute and 5 minutes, with the preferred trading chart time frame for this particular strategy being the 2-minute, as that is what we have found to be the most consistent performer for this particular trading strategy. I'll move these over. And you'll see that on our other SPX session videos, if you watch other ones on this channel, you'll see that that is the chart time frame that we use in all of our videos. However, if you prefer a different chart time frame for other particular reasons, if you're using other particular indicators to help you with your trading that you prefer on different chart time frames, just know that for this particular strategy, you would want to use something between the 1 minute and 5-minute chart time frame. Okay, so we have our 9:30 a.m. BBKPL alert. So this is a alert for a close above or a close below the BBKPL, and also the close of the candle on the opening candle has to be within the acceptable range. What that means is that there is a acceptable range filter which is set to 85. You can set it above 85 if you want. However, we don't recommend that. 85 is the max. That's why it is set as that as the default. You may find that you prefer it to be set to a lower setting in practice and use of the indicator for your particular trading purposes. However, we recommend that the most that you set it on is going to be 85. So what this does is it keeps you from entering a bullish or bearish trade off of a particular key level, whether it's a main key level or a contextual key level, where the close of that candle either above or below the particular key level in question is out of range. What that means is if it is out of range, if for example this was a close above but it was out of range, then the alert does not show. And so what that is telling you is that it is out of range for a trade off of that particular level that the alert is set for, in this case the BBKPL 9:30 a.m. opening candle, because the close of the candle is too far away from the stop losses that you would use, either one of the stop losses, the tighter standard, compared to the reward for at least the minimum reward target exit level for a scalp-only trade. This range filter can also be applied to other crossed and closed above alerts or crossed and closed below alerts as well. Those are turned on separately. There's also a show last alert only, which is a decluttering filter, in which if you have these alerts set for multiple different key levels, this will declutter your, if you turn this on, where it will only show you the last alert only for the particular alert type and the particular level for each one. So instead of showing multiple alerts for the same exact level, for the same exact direction, close above or close below, it will only show you the last relevant alert for the particular alert that's been enabled in question for each of them. So it's meant as a decluttering if you don't want to have tons of different alert labels, which if you're going to use all the different alerts for different levels, then we definitely recommend that you use this filter in conjunction with that. But we don't go on simply the close above or close below a key level. We're also looking for confirmation with the ribbon indicator. So in this case, we have the dual screen setup. As we mentioned earlier, you don't have to use a dual screen. The dual screen is if you're looking for double confirmation with the filter on as well as the filter off for indexes. In this case, we have double confirmation from both the filter on and filter off. In this case, the ribbon is green in both cases, all green. and we also had the close above, so we're getting confirmation on the bullish entry here. What would negate the bullish entry here on the close above would be if this ribbon was multicolored, or if the ribbon was the reverse color. So if the ribbon was all red, in this case, that would negate that entry, or if the ribbon was partially green and partially red. So what you're looking for on bullish entries is you're looking for close above the key level within the acceptable range, whichever key level that you're trading off of. And they were also looking for the ribbon indicator to also confirm the bullish entry by being all green as well. Ideally, in that context, ideally, you're also looking for the top part of the ribbon on bullish entries to be starting to pull away from the base of the ribbon, although that is not a hard rule. The very minimum that it does need to be all green. And on bearish entries, it's the reverse. So on a bearish entry, you're looking for the close below a main key level or contextual level, and then you are looking for the ribbon to be all red. Ideally, you're looking for it to not only be all red, but for the bottom part of the ribbon to be pulling away in the case of a bearish trade. And of course, if you have the dual screen set up, then you're looking for confirmation from both ribbons being either all green for bullish entries or all red for bearish entries if you're using the dual screen. Okay, so here we have the data boxes. There's basically several different option plays that you can use with this indicator and this setup. And it really just depends on whether you want to do a standard option play with two alternative for out of the monies, or whether you want to do the early session lotto options. So basically there are in the standard and standard plus two alternatives, there's going to be always three different option strikes that you can use on any bullish or bearish trade from any key level. And how that is determined with this indicator is as follows. So as an example here, we have a bullish trade off of the bull bear key price level. The standard option play is going to be the strike closest to the trade that your level that you're basing the trade off of. In this case, it's the bull bear KPL. 72.2944 is today's bull bear KPL price. So that the standard play is going to be using the option strike closest to that level. So with SPX, there trades in 5-point increments. So the closest one to that is the 72.30 call strike. Now you can utilize 0 DTE options or 1 DTE options with the strategy. So whether you prefer 1 DTE or 0 DTE is up to trader's preference. In the early part of the session, it doesn't really make a whole lot of difference as far as using either one. The difference really comes in the later part of the session as opposed to the early part of the session. We do have some videos on comparing 1 DTE to 0 DTE. We have a couple of videos that we've done. If you would like links to those, you can email us at daytradinggps@gmail.com and we'll point you specifically to those, in which we go over a comparison through an entire session of utilizing 0 DTE versus 1 DTE and the pros and cons of each. Now, how do you determine the standard out of the money two other alternatives for option plays with this indicator is as follows. So on this particular play here, it's off the bull bear key price level. Your out of the money strike 1 is going to be the closest strike to the first midpoint above the level that you're taking the main key level that you're taking the bullish trade from. In this case, that is the mid BBKPLR1 72.3794. The closest strike to that is the 72.40 call strike. And finally, the furthest out of the money, the third alternative, is the option strike that is one full key level away in the direction of the trade. So in this case, a bullish trade from the bull bear KPL, one level away is the R1 72.46.44. So that is going to be the 72.45 call strike. Then we have the data boxes here for both the entry. You're entering on the close of the 9:30 a.m. candle in this particular trade because it is taken off the opening 9:30 a.m. candle. So you're entering on the close of the trade. We have the ask price here for each one of those. As you can see here, the 72.30 was $17.80. The 72.40 was $11.70. And the 72.45 is $9.20. As far as stop losses, with the initial entry, your stop losses are as follows. So this is a bullish trade from the bull bear KPL. Your tight stop loss is the QL level below the level you're taking the bullish trade from. So in this case, that is the QL below the BBKPL. So that would be this level here. Your standard stop loss, if you prefer to use the standard stop loss, is the first midpoint below the level that you're basing the trade on. That is this mid BBKPL S1 level here. If this is instead a bearish trade off the bull bear KPL, it would be the exact opposite. Your tight stop loss would be the QL above, and your standard stop loss would be the first midpoint above. Works the same off of the other levels. If you're doing contextual level trades, again, as we pointed out, you go in the user control panel to that particular section. You pick standard or tight stop loss, and it will print the stop loss on the screen for you, which will also have a line label, which you can control the size of the color of the line label for those as well. We're not going to get into that today. As I said, you can go look at the setup and features video for this indicator. There's a section on taking trades off of the contextual levels. You can go to that chapter and go through that in that particular video. Okay, so what about the early session lotto trades? How are the strikes determined on that, and what levels are they based off of? Okay, so with this indicator in the daily key level strategy, there are two different types of trades that you can take. One is a scalp-only trade, and the other is called a regular day trade. With a scalp-only trade, you're looking for a one-level move in your favor as the threshold for an exit on a scalp only. With a regular day trade, you are instead looking for a minimum 1.5 level move in your favor as the threshold, or the minimum ideal 2-level move in your favor on a regular day trade. The difference between the two, other than the thresholds, is that on regular day trades, you have several different options as to what you can do once it meets either one of those minimum thresholds, either the 1.5 or 2-level move. Whereas on a scalp only trade, the only exit on that is going to be exiting 100% of your position. Whereas with regular trades, you do have the 100% exit option as well, like you do with scalps. However, you have several different other options as well, which we'll explain in a second. So with that in mind, the way that you determine the early session lotto option strikes is that you're using the minimum thresholds for the regular trade as the levels to pick your lotto option strikes for early session lotto option trades. So in this case, a 1.5 level move is based on where is the trade based from. So in this case, the bull bear KPL, R1 is a 1-level move in our favor. The mid R1, R2 is a 1.5 level move, and the R2 is a 2-level minimum ideal move. So on the early session lotto option trades, if you prefer that strategy, then over the regular daily key level strategy, you would utilize the option strike closest to the 1.5 level move in your favor. In this case, 72.54.95. So that is the 72.55 strike. And then lastly, the furthest out of the money lotto option to consider is the R2 level in this case, the 2-level ideal move based on where the trade is being based from, this bullish trade. 72.63.45, so that's going to be the 72.65 call strike. Now, what are some of the advantages of the lotto options, early session lotto options trade? One is cost. It's going to definitely cost a lot less to enter into these trades versus the regular 3 different strike options that are part of the regular strategy. So the cost is going to be a lot less. As you can see here on the 9:30 a.m. Close, the 72.55 is $5.20. Compare that to 17.80, 11.70, and 9.20. The furthest out of the money is $2.70 based on this level here. So as you can see, that's quite a difference, $2.70 compared to 17.80, 11.70, and 9.20. So one inherent option in that one inherent advantage, by using the lotto early session lotto option strategy is not only the cost, but the potential risk should the trade not go in your favor, or should price basically start going sideways and doesn't really go anywhere. So that's always a factor that you have to think about, is the amount of risk on any trade should price not follow through on what it appears to be doing. So that's always hard to tell. There's always lots of different factors that can come into play. There can also be, news flashes that come in, etc. And so on days where the price action will start moving sideways and doesn't really go to the stop loss or to a minimum target, then of course with the 0 DTE options, it's going to be eating away at the value of those options as time moves on. So it is an important aspect to think about how much money that you have out in general as well, on top of utilizing any stop loss. Also, with the lotto option trade, you also have the additional advantage in those, because you have less money total that you're putting into the trade, you're still going to be using the same stop losses that you would on the other ones on the regular strategy, either the QL below for this particular trade for the tight stop loss, or the standard stop loss, the first midpoint below. But you do have one additional stop loss option that you can use, and this is only because of the amount of money that you're putting in being so much less, and that is that you could use no stop loss as an example. And that would be an alternative that you could use with this, simply because of the amount of money that you have put out. So you can either use either one of these stop losses as the same, or you could use no stop loss, for example, here. And the reasoning behind that, we're not saying that that should be what you do. It's just simply an alternative that you have available to you that you do not have available to you with these particular ones, because of the fact that there's so much more money being put into the trade. The reason that you have that alternative stop loss with the early session lotto options, it's because of the amount of money. So if you think about it this way, on these particular option trades here, if price in the earlier part of the session starts going down and hits particularly the standard stop loss, there's probably going to be a loss somewhere in the vicinity of somewhere between the high 30% to as much as 60% of the original cost of the option. The reason it varies from that is that it just really depends on what the implied volatility is for the day, the cost of the options to begin with, and how volatility is playing out in this session, whether volatility is increasing or decreasing in the session. So there's several different factors that come into play for that. So for example, if you were trading this one here for 1780, and let's just to keep it simple, you can think of this as, let's just say 50%, and we'll just round this up to 18. So 18, a 50% loss on that would be $900. If we round this 1170 up to 12, 50% loss on that would be $600. And on this one, the 920, if we just keep that at 920 as an example, then that would be $460. Now compare that to the $2.70. So on this, if you did not use a stop loss and you prefer to not use a stop loss as compared to using the tighter standard, if you chose that option instead on your stop loss for these lotto options, the most that you can lose on this is obviously what your account was debited for, which in this case each option would cost you $270. So that's one thing you have to keep in mind. With this other one here that's based on the 1.5 level, you're in at $520. Not nearly as attractive for using that sort of no stop loss in this case. Probably the only one that makes sense for is this, is based on the amount of money that you're having to put in at the start. Okay, so now let's go into how these trades progress here. And keep in mind, as we discussed, that your scalp only exit is a one level move in your favor. So how that is determined is you take the level that you're basing the trade on, in this case the bull bear KPL. You look up, since this is a bullish trade, one full key level, that is the R1 level. So that is your scalp only exit. So if you're only looking to do a scalp only trade, that is going to be your 100% exit trigger on a scalp only. Then after you exit the scalp only, if that's your only trade of the day, then you can go do something else. Or you can also start looking for an additional trade opportunity off another key level should the opportunity present itself. Okay, so here we have the 9:34 a.m. candle here, in which it does hit the R1 level. The bid on the 72.30 is $24.60. The bid on the 72.40 is $17.40. Remember that entry was 11.70. The entry here was 17.8. Now we're at 24.6. On the 72.45, the entry was $9.20. Now the bid on the close of this candle, $14.10. What about the lotto options? If you're just doing a scalp only on that, the close bid on the close of this 934 on the 72.55, the one based on this level here, entry was $5.20, close $8.80. As far as the furthest out of the money based on this R2, we're in at $2.70. The close here, the bid on this close of this candle, $4.90. Now the 1.5 level move threshold again is the mid R1, R2 based on this bullish trade from this level, because it is 1.5 levels away in the direction of the trade. So here on this 9:54 a.m. candle, we have a hit of the mid R1, R2 level. Now you can either do one of two things. You can either exit on the hit of the level, or you can exit on the close of the candle that does hit the level. So if you want to do a close the trade on when SPX trades at that particular price level, that is one way of doing it. The other way of doing it is waiting to the close of the candle after it does touch that level. Either way of doing it is fine. In some cases, one will turn out to be better than the other. It's best in doing the strategy to just, from practice, to pick one or the other and stick with it. Our preference is to do it on closes of candles. Sometimes that will work for you. Other times it will work against you. What I mean by that is, in this case, as you can see, the close is above the level. Sometimes you will get where it touches a level and then backs off, and then the close is going to be less. However, in our experience, most of the time it works out to be greater by doing the close. However, that's up for each trader to decide for themselves and their own risk profile in how they prefer to handle their trades. So that's up for each trader to decide for themselves. Okay, so as we mentioned before, on the regular day trades, you have several different options once it either hits the minimum 1.5 level move threshold in your favor, or the minimum ideal 2 level move in your favor. The reason why there is two different thresholds for a regular trade is that the 2 level ideal move is called the 2 level minimum ideal threshold because on 80% of the sessions or so that you see in a normal volatility environment in a normal year, a 2 level extension above the BBKPL and below the BBKPL is where you're going to see price contained in about 80% of the sessions throughout the year. There'll be some sessions that are contained just within R1, or sometimes it will not even make it to R1, and you'll have more of a situation where it's contained within just below R1 to just below S1, and those happen on extreme lower volatility days where price is very compressed. It happens a lot on mean reversion market structures and on days where price just is basically consolidating. Then you will have other breakout days where price will move beyond R2 or S2 and will have a 3, 4, 5, or even 6 level move. But in 80% of the sessions, you will see price contained within a 2 level extension from the BBKPL in both directions, so up to R2 or down to S2. So the minimum threshold being the 1.5 level move, and then the minimum ideal threshold being the 2 level move. Okay, so here on the 9:54 a.m. candle, we have a hit of the mid R1, R2. Here we have the close on the 72.30 at $30.30. The 72.40 is $22.30. The 72.45 is $18.60. Now what about the lotto options? The 72.55, again, that was based on the mid R1, R2 level, is now $12.10. Remember, this was entered at 520. And the 72.65 based on the R2 level is now $7 on the bid on this candle close. Remember, that entry was at 2.7. Now, with the regular trade threshold being met hit, you do have a couple different options, as we talked about, as compared to the scalp trades. So what those options are is that the second alternative option, instead of exiting 100% of your contracts like you would do with a scalp, is the second alternative is to adjust your stop loss to break even or break even plus a minimum profit buffer on top of break even. So what we mean by moving to break even is not moving your stop loss to the bull bear key price level or moving your stop loss to the entry point. Instead, you're moving your stop loss to a price-based stop loss. So to begin with, we have a price level based stop loss based on either this QL below or the midpoint below. However, when we're doing a stop loss adjustment on a regular day trade, what we're instead doing is we're changing it to a price-based stop loss, meaning the price we paid, the executed price that we paid for our entry. So 1780 here, 1170 here, or 920 here, 520 here, or $2.70 here. If you're adding an initial profit buffer on top of break even, then you would want to add somewhere between a 10% to 15% profit buffer on top of break even, what that means is you're adding, say, 10% on top of here. So if you just want to round this up to $18, add on $1.80, that would make it $19.80. And again, you're making that adjustment when it is at $30.30 as an example. Now you can add more of a profit buffer. You just have to keep in mind that if you are going to add more of a profit buffer than that, you are taking the risk, because price generally doesn't just move up in a straight line. It will move up, it will retrace back, it moves up again. That's what happens most of the time. Sometimes you will have sessions in which it just basically moves in one direction for most of the session, but those are far and in between. That is not what happens most of the time. So if you make your profit buffer, your initial profit buffer, too much, then you do run the risk of getting stopped out. So if you're doing that and keeping all of your contracts, you just have to keep that in mind. The third alternative is going to be only if you are trading 3 contracts or more. And that is because the third option that you can have with a regular day trade is that you are closing out somewhere between 60 to 90%, so meaning the majority of your initial position at either the 1.5 level move in your favor or the 2 level move in your favor, depending on what your preference to use in your trading. You're closing out, securing those profits 60 to 90% of your original position at that 1.5 level move or 2 level move in your favor. And then on the remaining position that's left over, those would be your runners. And then on your remaining runners, you are adjusting your stop loss to break even or break even plus the initial profit buffer on those remaining contracts. And then what you're looking to do with those remaining contracts is, as price continues to move in your favor, at each key level move in your favor that succeeds from the original minimum threshold point that you've chosen to use, at each one of those additional key level moves in your favor, you have the same decision points or decisions to make as you did originally, and that is, on the remaining runners, are you going to either exit and close out some of those remaining runners and then further adjust your stop loss on the remaining runners by adding more profit buffer as price continues to move in your favor. Now, it's an important thing to keep in mind that once it does hit the minimum move in your favor, what does count as an additional key level for extended moves in your favor for those additional points? And that is going to be either a main key level, a midpoint level, or a contextual key level that occurs after at least the 1.5 level move in your favor. As you can see in today's session, none of the contextual levels on this particular trade occur after the 1.5 level move. If one of these was up here or one or more, then those would also count. But since they're not, we're not counting those in. Since they're not there, what we are counting is any main key level or any midpoint level. The QL levels do not count for that respect. They are only for tight stop losses above or below a trade on a bullish or bearish trade. Okay, so here on the 9:58 a.m. candle, we have a hit of the R2 level. That's now the 2-level minimum ideal move. Now, a minimum ideal move, as we mentioned earlier, that on 80% of the sessions in a normal year in a normal volatility environment, is going to be pretty much the extent of the move that you're going to see a 2-level extension away from the bull bear KPL in either or both directions. So at that point, at the 2-level move in your favor, generally speaking, it's a good time if you are more cautious minded to exit all of your position. Now, a lot of times you will leave money on the table by doing that because price will continue to move in your favor, but that's just the cost of using something that happens the majority of time, as opposed to trying to use a process that's only going to happen the minority of the time, the 20% of the time. So, but if you are inclined to keep a position to see if price does continue to move on beyond the two-level move in your favor, then what you want to do, if you're not going to exit all of your exit all of your position or exit all of your runners at that point, what you want to do if you're going to keep any position open, any runners from that point on, is that you want to tighten up your stop losses on any remaining positions by adding more of a profit buffer to where you can continue on with whatever remaining position you want. And as it moves in further key levels, you would generally want to add more of a profit buffer than usual once it's gone beyond the two-level extension, so that way you can keep profiting from the continued extended move, because frankly, especially in today's environment with all the news that can come out about the war, etc., you don't really know what can happen. We could get a 6-level move on any given day. The war could be declared over with. They have a settlement, etc., or things could ramp up and go in the other direction, and we could have a collapse in the market as well. So that's why during this heightened environment that we currently find ourselves in, that things could change on a hair trigger with news coming out. That if you are going to stay in after the two-level move in your favor with any remaining position, that you do want to be more cautious on your stops once that threshold has been met. Okay, so again, the 9:58 a.m. candle here, and the candle closed, the bid 37.30, so that is going to be a total profit here on this trade of $1,950 per option on this standard play. Here on the 7240s, 28.50. Remember, this started at 11.70. The 72.45 that started at 9.20 is now 24.30. Now, the first lotto option play that was based on the mid R1, R2 level started at 5.20. It is now $16.70. So that's approximately 221% gain on those. The furthest out of the money that were based on the lotto option play of the R2 level, the 72.65, starting at 270, is now $10.90. So that is a little bit over 300% gain. So that's approximately 303.70% gain on this. Okay, so that's going to wrap it up for today's video. We do want to mention that if you are interested in purchasing the daily key levels, SPX daily key levels V3.0 indicator, or the other add-on indicators for SPX, the VWAP, and the ribbon indicator, you can email us at daytradinggps@gmail.com to request a discount promo code that will apply to all of our different indicators. And we will send you a discount promo code once you send that request in, that will offer you a substantial discount on the purchase of either a single indicator or multiple indicators or one of our indicator suites. Also, some of you may be wondering how this indicator, how our daily key levels indicators have been working for people that have purchased the indicators and use them on a daily basis. So what we would like to show you to finalize the video here is, at the end of the video, is to show you the feedback and reviews that we've received from traders who utilize our daily key levels indicators on a daily basis. So we'll show you that in just a second. We would like to take the time to thank you again for taking time out of your busy day to watch this video. We appreciate that and appreciate your support of our channel. If you did like the video, we'd appreciate if you would hit the like button, as that helps us with the YouTube algorithm, so we would appreciate that. If you'd like to be notified when we post videos about any of our other daily key levels indicators for stocks, ETFs, futures, the NASDAQ NDX index, Forex, and cryptocurrencies, please hit the subscribe button and you will be notified when we post any new videos on those indicators or on any other trading topics. So now we'll show you the feedback and reviews that we've received from traders, and we appreciate you and your time today in watching this video. Thank you. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the daily key levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you.